Alright, so welcome back to another InvestaUniversity session. And today, we'll be talking about classical chart patterns. So why are chart patterns important? So for those of you who are newer to trading, it might seem weird to look for patterns at first. Especially for those who have no trading experience, papasok talaga yung thought na ano kinalaman ng mga triangles, rectangles, head and shoulders, etc. etc. However, understanding chart patterns is a crucial part of technical analysis. As technical analysts, our goal is to find repetitive patterns sa behavior ng price. By observing and understanding the behaviors and the psychology of buyers and sellers, we can find a way to create strategies that will help us earn a profit in the markets. So the patterns we'll go over today are some classical chart patterns that have been tried and tested for decades now. So even though these are already old patterns, they still work really well in the markets because human behavior, when it comes to the markets, hasn't changed that much over the years. Fear and greed still have a big effect on how prices move. Here are a few tips as well that we can remember when looking at patterns. So first is that pattern recognition is key. You have to go through lots and lots of charts and see patterns in action so that you can start to distinguish the different patterns the markets present. You have to take time to study the different behaviors of buyers and sellers whenever these patterns occur. How does demand and supply interact with each other and all that? So second, patterns take time to form. Patterns don't form in just 1 week. Usually, most patterns take multiple weeks to properly create a setup. The logic here is that when these patterns form, shares are exchanged between different hands and it takes time for that exchanging of hands to happen. And third, patterns don't work 100% of the time. So anything can happen in trading. There's no single method for us to know for sure what will happen. However, patterns help in the sense that they help us get an edge in the markets. And lastly, not all patterns are textbook perfect. Sometimes shakeouts, bull traps, and bear traps occur. Just because a pattern isn't picture perfect doesn't mean it's not potent anymore. So with that last tip, I'd also like to mention that ideally, we shouldn't memorize these patterns. It's way better to understand the context behind these patterns so that we can better gauge what the market's trying to tell us. And so with that, there are two main groups of chart patterns we'll be discussing. So there's reversal patterns and then there's continuation patterns. So reversal patterns, as the name suggests, refer to patterns we often see before the trend reverses to the other direction. So let's dive into each one. So head and shoulders, here you will notice a high followed by a higher high, then suddenly a lower high forms. So basically, it's a sign that buyers or bulls have started to lose control and are having a hard time pushing prices higher. So once the neckline is broken, it becomes a clear indication that the trend is already reversing. And double bottom, so for double bottoms, it signifies that the trend has slowed down. So prices have now met a wall that it's having difficulties getting past. And although most people often think that double bottoms should have higher lows, sometimes having a lower low occur can cause the pattern to be stronger since the move could have been caused by institutional traders or fund managers trying to make people sell. But generally, the second low should be near the first low and it could be a bit higher or a bit lower, but overall it shouldn't be too far apart. And then the next one is the rising wedge. So a rising wedge signifies that momentum has already been exhausted. A key characteristic here is that prices are still going up, but it's noticeable that as time goes on, pahina yung momentum. So although sa later lesson pa ito madidiscuss, it's also common to find RSI divergences form whenever you see wedges in the market. So just wanted to note as well that for reversal patterns, usually you'd want to wait for the neckline, the major support, or the major resistance level to be broken first as confirmation that the trend has finally reversed. Also, for the bullish versions of these patterns, the inverse head and shoulders, the double tops, the falling wedges, all you need to do is invert the patterns. And then, so basically, yung head and shoulders, inverse mo lang, yung double bottom, magiging double top. The rising wedge becomes a falling wedge, and so on and so forth. Alright, so on the other hand, we also have continuation patterns. So continuation patterns are patterns you would usually look for if you want to follow the trend. So for continuation patterns, usually pareho lang naman yung main logic among the different patterns. Basically, in the markets, prices don't move in a straight line. Usually may ups and downs, and it so happens that for uptrends, mas mahaba yung up moves, and vice versa naman for downtrends. Usually mas mahaba yung down moves. So continuation patterns or consolidations need to happen in order to maintain the health of the trend. As more and more people are making money on the current trend, there will become more profit takers who are happy with what they've gained and they want to cash out their profits already. So essentially, the markets will take out these shorter term traders para matitira na lang na holders ng coin are those looking to hold for the long term. If this doesn't happen, yung pag-consolidate, yung pag-shake out ng profit takers, then nagiging overcrowded yung asset, and as more and more people are looking to take profits, usually ganito nangyayari yung mga big drops in the market because nagiging overcrowded na yung trade sa higher price levels. So the different patterns help us identify, one, if the trend is sustainable, and two, where the optimal entries and exits are. So let's dive into some popular continuation chart patterns. So first, we have the triangles. So there are three different kinds of triangle patterns: the symmetrical, the ascending, and the descending triangles. So for symmetrical triangles, these are consolidations where both lower highs and higher lows are forming. Usually, if you want to make a trade, the primary basis is the break of the latest lower high with stops set at the break of the latest higher low. For descending triangles, you're usually met with a horizontal support level with lower highs forming. Here, ideally, you'd want to enter at the break of the latest lower high with the horizontal support as the basis for the exit. And then next one, for ascending triangles, so these take the form of a horizontal resistance with higher lows forming. So among the three, this is the easier pattern to trade on the long side, since clear na kagad na after magkaroon ng breakout, onti na lang supposedly yung supply sa taas. And also, stops are usually closer to the entry given that higher lows are forming. Then of course, you also have the Darvas boxes, or basically rectangular consolidations. So somewhat straightforward. Usually the entry point here is on the breakout of the resistance with the exit based on the support level. Among all of these patterns, ideally you'd also want volume to remain low during the consolidation with the breakout point exhibiting higher volume than usual. So this signifies that institutional holders are still there in the trade, and that the traders who sold their shares were mostly retailers or somewhat smaller fish. So the higher volume during the breakout confirms that demand is still strong for the cryptocurrency. And overall, as what I mentioned, you don't need to memorize all of these patterns. In fact, there are other variations and different patterns that you can learn more about. The common denominator among all of the patterns is whether or not buyers or sellers are in control, or whether or not if bulls or bears are in control, and also if the control is about to get shifted to the other side. And that's pretty much it for today's lesson, and we'll see you again next time.
So that's it for today's lesson. Hopefully, you guys learned a lot. And for those who are just tuning in to our crypto trading bootcamp for the first time and would like to enroll, here's 3 easy steps so you can enroll for free. Step 1 is to create an Investagrams account. You will need an account on Investa to access the quizzes and our exclusive group. Step number 2 is to join our exclusive investor group on the platform. This is a place where you can ask questions directly to our educators and receive instructions for quizzes and activities. Step number 3, subscribe to our YouTube channel and follow our official Facebook page. All recorded videos of our lessons and important announcements will be posted on these channels.